Good morning. My name is Robert Misey, and welcome to my continuing series on the international tax provisions of the 2017 Act and how they impact us. Today, we're going to talk about Section 956 inclusions, which were relatively untouched by the 2017 Act, but by the end of this episode, we'll see how it has impacted us. Section 956 creates an inclusion for an investment in U.S. property. That investment in U.S. property includes a loan from a CFC to U.S. Co. How does this happen? Typically, it's because the CFC has a lot of cash and U.S. Co. doesn't want to have to pay tax on the dividend or the deemed paid foreign tax credits in days gone by would not be strong enough, would not be enough to eliminate the U.S. tax liability. So 956 says this is an income inclusion to U.S. Co. However, the code and regulations go even further. And if there is a guarantee by a CFC of a loan, a purely domestic loan from U.S. Bank to U.S. Co., there's also going to be an income inclusion under the rationale that that guarantee is using the value of the CFC to get money into U.S. Co. It goes even further. And a pledge of 2/3 or more of CFC shares as collateral for the loan would also result in an inclusion under Section 956 to U.S. Co. But what happened in the 2017 Act? The 2017 Act exempts from U.S. tax dividends a C corporation receives from a dividend. So you had the odd situation where a CFC's dividend to a C corp were exempt from U.S. tax, but the loan would result in U.S. tax. So what did the IRS do? Well, without any prodding from Congress, what did they do? The IRS exempted C corporations from Section 956 inclusions. Now, if we have a C corporation, we don't have to worry about loans from a CFC. We don't have to worry about guarantees by a CFC. We don't have to worry about pledges of a CFC's shares. However, other U.S. owners still have Section 956 income inclusions for loans from CFCs. So, for example, if you have an LLC, or as depicted here, an S corporation that takes a loan from a CFC, the S corporation is going to have an income inclusion under 956 that will pass through the S corp and go upstream to the individual U.S. shareholder. What's the lesson here? We no longer have to worry about 956 with respect to C corporations. Many companies, as a result of the 2017 Act, are changing their form from S corporations to C corporations, typically to take advantage of that lower 21% tax rate, but for a variety of other reasons too. If you have an S corp that has a CFC and wants to get something out of the CFC, this may be another reason for the S corporation to convert to C corporate status. Well, thank you for joining me on our continuing series. I look forward to talking with you next.